Hey, everybody, welcome. Welcome. Thank you so much for joining us. Welcome to the Millennials Investing in Real Estate Workshop Series, virtual edition. All right, we are back in effect. We last met up at Third Baptist Church of Chicago on 95th and Ashland. There is where we held our workshops. We got good into it, and then the pandemic hit, but we're not going to let that stop us. We're right back here with the series. It's a 6-module series, and today's workshop is talking about the qualifiers. You've got 5 more going all the way into the month of March in the 2021 year. So stay tuned, sit back, you're in for some good information and some special announcements as well. So talking about the qualifiers is pretty much going to get us into what that looks like when you're going to get properties, whether it's a home, even with commercial, what it is that you actually need to be looking for when you're getting into that process. The first and foremost thing that you need to do, despite what many people may tell you, is you need to get qualified or pre-approved, as you will hear people say. You need to get pre-approved. Why do we need to get pre-approved? Mortgages, loans, interest rates, all of those things like that. We need to be familiar with what those are, and we need to know what's going to have the biggest impact on our borrowing capabilities. And the only way you know that and the type of risk that you can take is by talking with your local lender, whether you bank with someone, a credit union, things like that, so that you can understand what your needs are and how they can be met by that lender, because every lender's guidelines are different. Some of them have what's called overlays, which are additional fees that could be added on to base guidelines that every lender follows. And you also need to know what your interest rates are, because of course that will affect your bottom line, what you need to pay every month, and of course what you're going to be paying over time on that loan, right? So let's get into the different types of loans that we'll be talking about. As you can see, there are a plethora here. Some of you may not have known that there's more than just one type of loan. When you go to get your loan from your bank, it's not just, hey, give me a loan. Okay, this is what the loan is, and then we're done. Knowing what type of loan that they have, that they offer, and what you need are important. For instance, you got the 30-year fixed, traditionally called the traditional, no pun intended. It is a 30-year loan, just as it says, with a fixed interest rate. So for 30 years, how many of you, especially with this being a millennial call, and of course, not just millennials are invited, but how many of you think when you purchase your home, you're going to stay there for 30 years, right? But if this mortgage wasn't 30 years, you wouldn't be able to afford it. And I'm speaking just in general, because as you can see right next to it, there's a 15-year. How many of you are even thinking you're going to be in a property for 15 years when you're purchasing right now? The point I'm making is the reason why the loan is affordable in the way that it is because it's stretched out over so many years. And since it's stretched out over that many years, you want to know what you're paying into that, even though you're probably not going to be there all of those years. You're still paying into what that means to have a loan for that long, right? The interest rate, the points that the lender may charge. All of these are basically wrapped into fees called points that they charge, which is how they make money, sort of like a commission, if you will. But with lending, it's called points. If this was like a car, a 3 or 5-year loan, it would be super unaffordable because of the price, the cost of the asset, right? A vehicle is not an asset, but the price of that is a little more affordable than the price of a home. Therefore, the term of the loan does not have to be as long in order to make that note, a realized amount to be paid by someone. So these loans carry the fees and the interest rates that come with that length of a loan, that term of loan. So for 30 years, you're paying, for instance, right now, interest rates are super low. It is a phenomenal time to buy, which is why these workshops are so crucial. We're going to keep embedding that into your minds in every workshop, even beyond the qualifiers, because we have to make sure that if you're not jumping and getting your feet wet in workshop 1. By the time you get to the 6th workshop, we plan to have the majority of you, if not all of you, already searching and purchasing properties. All right. Okay. So with that being said, you need to know consistently that this is the best time to buy. This month, the next month, the following month, whichever month in which we're holding these workshops, we're going to get you in that process. We're going to get you into the loan that works best for you. At least we're going to guide you into that direction. So the 30-year loan, again, is for 30 years. You're paying whatever those fees are, those interest rates and whatever have you over time, monthly in your loan. The 15-year is literally just that. The loan is for 15 years. So you're going to be definitely paying whatever that is over the term of the loan for 15 years. If you don't keep the property for 15 years, of course, you're not going to be paying the remainder of the loan, but you definitely have to pay it off. And in order to do that, obviously, you have to sell it for more than what you owe in order to pay it off. If you sell it for less than what you owe, you're going to either pay that difference yourself to make up for what that loan amount is that you owe, or you're going to do what's called a short sale. And we'll get into that in some other times and some other modules. But just to give you an idea of what these terms look like over time, getting into the right loan up front makes sense because of that reason that I just mentioned. You want to be able to pay it off when you're done with it. And I say that candidly because a property is an investment. And you don't keep an investment forever unless it's making you money. If it's not making you money, there's a time where you're going to have to let it go. Okay, whether you live in it or you don't live in it, whether it's a property you're purchasing for a business, you hold it for a specific period of time that you've projected that it's going to benefit you. And when you come to head on that benefit, it's time to release it and get into another investment. It's what the rich do. It's what we need to start learning to do. We need to start thinking like that. These are investments. We're not in love with any of these properties. We're in love with what they can do for us and our families for generations after generations after generations. Okay. We got the jumbo loans, and some of these you might not even need to get into. Some banks don't even offer them anymore. Jumbo loans are in fact back. They didn't used to be around for a while, quite a while actually. You got, and I don't want to get into too many details about a lot of these loans. I just kind of want to let you know that there are so many out here, but some of the general ones that you're going to hear about and run into more familiarly is the 30-year, the 15-year FHA and VA, possibly the USDA, probably not so much, and Fannie Mae and Freddie Mac when you're getting into bank-owned properties, because those are guarantors of loans with banks. Once they go into foreclosures or things like that, then Fannie and Freddie have actually guaranteed those loans up front. And so when they default, they buy them from the bank. And then they turn around and try to sell them. So that's kind of what that process looks like. And we'll get into that again in different modules. Right now, these are just the bare bones and the basics. Your FHA is your Federal Housing Administration. And what those are for is to indicate is for 203 loans, 203K, renovation loans. Not necessarily do they have to be those, but FHA loans typically are owner occupied loans. Okay, those are administered by the Housing Urban Development. Those are federal funds that you're getting when you get those from the bank. Okay, they have strict guidelines, more strict guidelines than the regular traditional loans that I mentioned earlier, where they have basically their own inspector that comes out and looks at the property and really scrutinizes any and everything to ensure that it is a good investment risk for the investors that are offering those funds to you in the form of an FHA product. Okay, so when you hear people say, what type of products do you have as a lender, or the lender saying the products that we have, what they're talking about are the loan types. Those are the products. And the VA loan is for the Veterans Administration. Those are for veterans, military, whether they're in the military or they're already discharged from the military. Those are the ones that can use the VA benefits. And matter of fact, now there's no cap on VA benefits, which is an amazing thing. And one of the wonderful, amazing things, it is one of the best products out there, no down payment. So if you're a veteran and you didn't know that you had this benefit, you have this benefit and you can use it more than once at a time. Talk to your lender about that. There are some stipulations to that, but you absolutely can own a home and then turn around and also have another home, especially if you're active, because typically you're moving around. And so with that time frame of your purchase, which is very scrutinized, again, speak to your lender, you definitely have to make sure that you're aware of those parameters so that you know when you can purchase and under on what guidelines, what premises that you can actually purchase under. But it is possible. But ordinarily, you can only purchase once and use your benefit funds once and only once. Okay. And again, USDA. So USDA 5-in-1 arm jumbo, you may not be getting into those products. Just wanted you to let you know that these are some of the ones that are generally out here. There are actually a ton more than this. Make sure when you're talking with your lender, you're finding out what products they have and you're asking which product would work best for your scenario once you let them know what you intend to do. And of course, once they ask you about your finances, your capabilities of actually getting into a loan, and not just getting into a loan, but being able to sustain for the term of the loan, right? They're going to ask for different things like reserves in your account, which are your funds that you're saving up or that you're holding on to use for down payment or closing costs or things like that. This is not the workshop where we're getting into the bits and crumbs of those potential pieces of the loan products. Is really to just get you, again, familiar with understanding that there's more than one. And so when they're giving you a quote on a loan, you're asking what type of loan is it and what is the comparison for that loan to another type of loan or another type of product, so that you ensure that you know what you're getting into. And every bank doesn't offer FHA financing 203Ks. Again, those 203Ks are to renovate properties with. Those are the types of loans that help you purchase the property and pay for the renovation, all under one loan called a 203K loan. The 203K loan is split between two types of loans. There's a 203K streamline, which is up to about $35,000 in renovations needed. So you might run across a building that doesn't really need that much to be done to it. Then you would go with the streamline. With the 203K full, there is no maximum, of course, based on your qualifications. There is no maximum like the streamline, but it's still based on the amount of work that's needed in a property that you're purchasing. And you would know that by getting your estimates from general contractors, preferably licensed ones and insured ones, to give you an estimate on what it would cost you potentially for those repairs, because you're going to need to know that when you're going to go and get that loan. You're definitely going to need to know that. There's no way to know for the bank to say, okay, well, we're gonna approve you for this amount. Well, you don't even know if that amount is enough for the property that you either are considering or that you may eventually find. Okay, we'll get into that in a little bit. Let me just keep moving. I just kind of wanted to give you just some brief information and some details about what in fact that looks like. Okay, moving on to the next slide. Let me see, I think I skipped the mortgage approval process. The mortgage approval process is definitely something we want to make sure we stay focused on. Here's an in-depth look at it. You get approved, you start going to look at your house, you fill out your loan application, your mortgage application, they process your loan. It goes through underwriting, which is when they start verifying, making calls to find out about your job or, checking into your financials that you provided. They look into everything that was provided as far as with the property. The inspection came back, the appraisal came back, it was valued out. And then of course, once all of that is confirmed, you get what's called a CTC, or that clear to close. Okay. So once you get into all of that, that's when you then finally learn that I'm ready to close this deal. So that was just the 1 through 6 one-stop shop look into the loan process and what that looks like. Okay. Why do I need to get pre-approved? 3 reasons. 1, your realtor needs to know what price range works for you, right? They need to know what range works for you, what types of properties, what locations and things work into the guise of how much your bank or your credit union indicated that you were going to be pre-approved for. So the words and terminology is crucial. You're not approved. You're not approved until you get it clear to close. So it's a pre-approval. This is the step that you go through to get to that approval. And in order to know where we should be looking for properties, we got to know how much the bank actually said they're going to give you, right? We got to know how much they said they're going to give you. The last thing we want to do is take you shopping, looking at a bunch of houses, get your hopes up high, or a bunch of properties, whether it's commercial or what have you, and then go and find out that you cannot qualify for that building that you just looked at and that you just fell in love with, right? That's not what we want to do. We want to make sure that you get what it is that you are able to get. You're looking at what it is you're able to finance, right? Secondly, sellers are willing to enter into negotiations with you when once you place an offer on the property, you actually have a pre-approval attached. Personally, as a practice of mine, I don't choose to work with purchasers who don't feel they need to get a pre-approval and they just want to go look at a bunch of properties. That's not good use of our time on either end because we don't know what we're looking at. Just to want to look is not how I like to spend my time. I want to look at something that's actually going to get you to your mark. I want to help you get to your mark sooner than later, unless you got a delayed preference. Well, if you have a delayed preference, then we basically have delayed actions. We're not going to look yet because you're not ready yet. When you're ready, you'll get your pre-approval. Once you get your pre-approval, then we can move forward to look in the areas and at the assets that fit into the pre-approval. Make sense? I'm hoping you're nodding your hair out there, your head's out there. Lastly, this is a step you have to complete to close, right? I just mentioned that on a previous slide. This is what you need to do to actually close. You have to fill out the loan process, the loan application. You actually have to have the bank go through a process to say if they would actually even consider you for a loan. They have to go through that process themselves, right? So you're killing two birds with one stone, basically, with one PA, I like to put, with one pre-approval. You're killing two birds. One, you're getting that together so that you can have sellers willing to get into negotiations with you once you've been out there looking in areas and at properties that can actually work for you. And two, you got to go through this anyway to close. So you basically got to jump on the process. Okay. You got to touch on the, you got to jump on the process without spinning your wheels, so to speak. Okay. Now we got some pros and cons though, right? We got some pros and cons. This is from a resource called myfico.com. Feel free to check that resource out. Conventional loans, pros and cons. One of the pros is down payments are as low as 3%. You can get a down payment for as low as 3% on some conventional loans, right? No PMI, which is private mortgage insurance. If you put 20% down, again, even though it's low as 3%, if you elect to put 20% down, then you are basically 80% vested into that asset. And then you don't have the private mortgage insurance that's typically tacked onto your monthly note, right? Your monthly mortgage payments. It can be canceled if you don't put 20% down. Once your loan to value or your vested, as I just mentioned, gets to that 80%, you can cancel that PMI, even though it says 78% on this slide from myfico.com, but you get the message, right? It also can be used to purchase second homes and investment properties. Remember, I said earlier, 203Ks cannot be purchased for that. You can't use that as an investment property. You have to actually be living in the property in order to get in order to get an FHA product. You have to live in the property as an owner occupant. Okay. Some of the cons with the conventional loans. It's a higher rate for lower credit scores. So it is important to make sure that your credit scores are up to par, right? What we don't want to do, and I stress this, lenders stress it as well, but I take it upon myself to also stress it. You do not want to apply for anything when you even think you're getting ready to go and get a pre-approval. Definitely once you get one, because they pre-approved you based on the status that you were when you went to go get pre-approved. If you change that by applying for anything and someone is pulling your credit, you are changing the perception of your risk to the bank. Because right now, when they pre-approve you, your risk is as it is, right? Once you start applying for things, now you're a risk for someone who may incur more debt and be unable to pay them back. That's what their concern is. are you going to be able to give me my money back? That's what the investors of banks are considering, right? There are income limits, soft debt to income limits. So there's a DTI, debt to income ratio, that banks look at to make sure that they will approve you for a loan, and they've done all of their checks and balances against the guidelines of whatever their investors have put forth for them to actually issue loans on. And those ratios are basically whatever percentage of your income is versus your debt is it has to be met and has to be followed. So you can't have so much of a percentage higher than what the amount of debt is that you have. So in this regard, on the front end, it's 28%, and on the back end, it's 36%. So your expenses can be no more than 36% of your income. So technically, sometimes you can actually even figure out for yourself what type of rate you would get from a bank. You know, they would provide the rate sheet, so you can go into myfico.com or bankrate.com and things like that, and kind of look at what interest rates are and what rates are, what loans are looking like at each financial institution, and find out what their DTI is, and then figure out your own DTI, right? Maybe throughout these workshops, I'll actually get a DTI calculator and see if we can embed that into a link so that you guys can actually use that. Maybe I'll do that. I'll put a note in the chat. If I got my husband on the line, Ernie, if you could put that in the chat for us, that would be phenomenal. I'm going to move on. Tougher credit guidelines as well. We kind of touched on that a little bit. They like to see credit scores at least of a 620, some a 640. Depends on the lender, like I said. So don't get discouraged if you go to one lender and they indicate that you cannot get financed. That doesn't mean anywhere. That just means with them. So the first thing you're doing before you even letting people pull your credit, for one, you're finding out what your credit is on your own. Annualcreditreport.com, you can get your credit report once a year for free. Okay, you can get that once a year for free. And what you want to do, Credit Karma is a great source as well. It's a soft pull. It's not a hard pull. What I mean by that, it's not something that when you go to the car dealership or the bank to get a financing instrument for your property that they would use. They wouldn't use what is on Credit Karma, but it's a guide for you to show when your score is going up and when your score is going down, and you have access to TransUnion and Equifax on Credit Karma. So you can go in there and look, and it's an app too. You can go in there and look and see what's on your report to at least keep tabs on it to know what belongs and what doesn't belong. And you can see your score. So if your score says it's a 650, it might be a 660, 670. It might be a 640, 630. But the point is, the next time you go back in and check, if it was a 650 the last time you went in and now it's a 670, you at least know that it went up, right? That's what you really know, it went up. And then you know why it went up, because you can look at those two reports to see what may have hit your report, what may have been paid off, what fell off, things like that as far as items on your report. So that's how you can find that out. Also, another con is the reserves money needed after your down payment. So you need down payment to bring to the table, right? And the more of a down payment that you bring, the more your monthly note goes down as well. So it would behoove you to have funds available to put down, even if they say they don't need money down or they only need 3%. If you can put more down and it makes a difference in that monthly note that you pay, right? Then you might want to consider doing that. Most banks require at least 2 months of liquid assets that you have. PITI is principal, interest, taxes, and insurance. Those are the components that your monthly mortgage note is made of. The principal balance of your loan, the principal amount of your loan in proportion to the monthly amount that you're paying, the interest rate, the taxes that you're paying, and the insurance. You have to get insurance, obviously, on your property. Those 4 components make up the monthly total that you pay on your property, for the mortgage. So having at least 2 months of that stored is what some lenders require when they're offering the conventional loans, okay? So just keep those in mind. All right, moving on. Let me make sure I didn't move this screen. Renovation loans. We're going to jump around to renovation loans that we were talking about earlier. So the FHA 203K needs a consultant, a HUD consultant. which is what I was mentioning to you earlier, that comes out and they scrutinize the process for the units. Anything from 1 to 4 units is considered a residence. Anything beyond 4 units is commercial, okay? So if you get a 4-unit building, you can still use a residential loan to purchase that property. Even so, a 203K loan, which means not only can you purchase the property, but you can also renovate the property with the same loan, right? Sounds interesting, right? Okay. So you have to have a consultant for that. You can also use it for a refinance product. There's a streamline that I was mentioning to you, which is up to $35,000 in renovations for the property. And of course, Fannie Mae has a product called Home Style. So remember that word product, get you familiar with that so you know what they're talking about. Fannie Mae has a product called Home Style. So you can purchase a property using a Fannie Mae loan under the product called Home Style. And the minimum down payment for that is 10% for 1 unit for a primary residence and second home, and 20% for 1 unit for investment properties only, okay? You can have gift funds for both of them, as you can see, the FHA product as well as the Fannie Mae product. With Fannie Mae, it's on a case-by-case basis for down payment properties just for owner-occupieds, though. You have to live in the property for that one on a case-by-case basis, okay? So I want you to definitely keep that in mind. And gifted funds basically means if you don't have the funds yourself to show as reserves, for instance, or that you had available, someone can actually gift you those funds. And oftentimes they'll tell you what their guidelines are that they require. They may want you to submit a letter that says so-and-so gave so-and-so, which would be you, this much money, and the letter is dated and signed, and they may or may not want it to be notarized, but it is doable, is the whole point. The mortgage insurance, again, is required on FHA loans for the life of the loan. You cannot get rid of it, okay? For the life of the loan. For Fannie Mae properties, the down payment is if it's less than 20% on a finance and LTV and 80% on a refi, okay? Oops, sorry about that, guys. And let's see, the maximum renovation amounts, again, there's no maximum on the 203K, the regular 203K or the full 203K, as people call it, right? As long as everything fits within the guidelines, and then $35,000 for the streamline, okay? And then 50% of the as completed value, or the ARV, after renovated value, or after renovation value, or after rehab value, whatever you want to use the R for. The point is they will give you that amount of financing on the property once the property is in fact, once you do comps, once you pull comparables on the comps. So we just want to make sure that that's understood, okay? Lastly, the allowable repairs, from structural changes to landscaping for new appliances and more, for the FHA 203K. Flooring, painting, kitchen, bath appliances, and all that kind of stuff. Nothing major or structural can be done with the streamline. Again, when you're looking at that $35,000, it's because not much needs to be done to that property, and so you would use that loan. And that determining factor would be made by your lender. Okay. And let's just make sure everyone mutes themselves. Okay. We want to make sure everyone stays muted until we have the question and answer sessions. Thank you so much. Also, for the Fannie Mae Home Style, you can do anything from structural changes, landscaping, new appliances, and more. Okay. All right. So those are some options for your renovation loans. The mortgage loan application process, it's a tedious process, but the more you're prepared in advance, the more bearable this process can be, and enjoyable. We want this to be an enjoyable process for you, right? We need this process to be enjoyable. You're doing something that you probably have never done before, and at the same time, you may do it again. So what we aim to do, and what we would like to do, is ensure that you are well prepared for this process as you go into it, right? You're well prepared for this process. So for instance, let's go to applying for the loan. Once you apply for the loan, you then have employment documentation that you may need to provide. You have income documentation you may need to provide for whatever, self-employment, whatever have you. You need to show your assets, your debts, any property information that you may have, properties you already own, any financial blemishes on your credit. They're going to be looking at that as well. Also, the mortgage type, you're going to be learning about what type, and we just heard about some products. You're going to be learning from them what type of mortgage loans that they have available. If you have a VA, they're going to be looking for your certificate of eligibility, right? And then they're going to give you an estimate for what your loan, what you qualify for, and what that monthly amount could potentially be, the PITI we just talked about, right? And what your interest rate's going to be. By law, they have to provide you that, and they have to be within a certain percentage once they actually finalize what those numbers are. The numbers have to actually be specific to what the product is, the asset is that you're purchasing versus just an estimate now. The numbers get finalized before you close because you need to know for sure what that's going to cost you. You need to know for sure how much you're going to be paying a month. You need to know this information for sure, right? Okay, so you'll be getting that from the lender. Okay. Let's see. Okay. I'm sorry, fella. Give me 1 second. The slides have somehow put themselves in their own order. You know, if anything can happen in technology, it's going to happen, right? Let me roll you back. I do apologize. All righty. I'm not seeing the rest of my slides here. Hold on. Hold on. Technical difficulties. Stand by, people. All right. We're just going to refresh the screen a little bit. Nothing wrong with a little refresh. No, we don't want to do that. I guess I should have indicated that I do have a MacBook. I'm learning how to use my MacBook, and I went through this to be sure that I was going to be right on point with it. And clearly we are not. So stand by, please. All righty. Stop. And if you have any questions, type them in the chat. I can answer questions while we are troubleshooting this. And we'll get right back on schedule. But if you got any questions, feel free to go ahead and put them into the chat, because we like to hear kind of some of your questions or concerns that you might be having right now. What are you thinking from what you've heard so far? Might not have been something you were privy to, and now you're feeling a little more confident with actually going to get to apply for a loan. What are you thinking at this point? So feel free to type that in if you have anything that you wanted to share about that. And we're going to be showing up again at this very station. And I promise you next time it will be working right. Okay. So we'll be making sure we're getting into the slides and the information and the details that we want to get into. So we're back on track. I got the slides up. I just needed to do a quick little refresh. And we're going to start sharing the screen to get you back on point. But anytime you guys have any questions, feel free to pop them in the chat. We'll be more than happy to continue to answer those questions as we move along. Thank you so much for dealing with the technical difficulties for today. We'll jump right back into the FHA loans. I won't stick on it long because I kind of did that in the last 2 slides. But once again, getting an FHA loan is 3.5% down. It's one of the most popular products out there right now because of such a low down payment requirement. The only lowest one outside of that is, I would say pop it in the chat and see who was actually listening, but I'm gonna go ahead and tell you, is the VA loan, 0% down with the VA loan, okay? The pros to FHA loans, again, the low down payment, they're better rates than conventional loans, right? The credit borrowers, 760 FICO conventional, 620 FICO for FICO conventional, or average FHA loan 3.978%. Okay, they have more lenient credit score guidelines. It's a 580 credit score minimum that some banks, some lenders will do. So if your score is a 580, now here's where I kind of, I'm a little leery in that regard because of a couple of things, but 2 primarily. 1, if you're at a 580, what that does indicate is you may have a lot of debt. It doesn't necessarily mean you have bad credit, but what bad credit is just a large amount of debt, right? Poorly managed credit is a lot of debt that you're not paying or taking care of, or that's in default. That's poorly managed credit. But overall, debt in and of itself is not a good thing, right? If you can purchase with cash, please by all means do so. Why pay the interest rate to anyone? But how many of us are in that position where we can do that? So you want to put yourself in the best position. So one, having a 580 credit score is an indicator of most likely poorly managed credit, which then leads to the second reason that if someone is lending at a 580, you might poorly manage your mortgage just based on history in and of itself of your credit. And it might not be affordable for you because you've got so much outstanding unwinding debt, right? FHA has a low as low as $500 with 10% down. 500, I'm sorry, FICO score with 10% down, right? So if it's a 580, it's 3.5%. But if it's a 500 credit score, they're killing me here. It's 10% down. Let's get the credit together, though. Is my point with it. It's a pro on here, but let's get the credit together. Unless that 500 or that 580, once again, it's just a lot of credit. On time paid credit, but it's just a lot. That can lower your score too. You can have the best payment history in the world, but if you have a lot of debt, a lot of credit, right, that score can be low as well. Another pro also is lower mortgage insurance rates than conventional. 1.75 upfront MIP, mortgage interest, remember, and 0.45% to 1.05% annually. Okay. Your mortgage insurance is not cancelable. I repeat, it is not cancelable. We don't want you to get that confused with PIM, right? All of these acronyms, right? We don't want you to get confused with that. You cannot cancel your insurance. You got to keep your insurance. Okay. If it's less than 10% down, MIP lasts for the life of the loan. Okay. Many might refinance you into a conventional loan, though, and then drop that MIP, right? Because there's none on a conventional loan. But on the FHA, there is. If you put less than 10% down, it stays on for the life of the loan, and that can only happen at the upfront of acquiring the loan. Okay, keep that in mind. It's not as time goes on, 80% you get rid of it. That's not what this is. Okay. Also, many condos are not approved. They've changed some laws with this recently, with condos not being approved and being able to still get financing on them. But some people, some lenders are still leery about that, right? Owner occupancy percentage limits are there for FHA loans, right? Remember, we talked about that earlier. You have to be owner occupant, and some people want to actually purchase it for investment purposes to fix and flip, right? Or fix and hold to rent them out. And also you have projected financial condition limits, okay? Things have to be in a certain way. They have to have, again, the investor's best interest in mind when they're approving for these financial loans, these products. Owner occupied homes only, right? We're talking about that again. And of course, loan limits based on regions. Lower limits in 65% of the conforming loan limits, and the upper limit of 150% of the conforming loan limits, right? In certain areas, in certain regions. So talk with your financial advisor on that, just to make sure that you're understanding those terms in particular. We won't get too much into detail about that, but a lot of those are the cons. And oftentimes you will find that you're not able to be as wide range with your search as a result of some of these limitations. Okay. Pros and cons for VA loans. Remember, we already talked about the fact that VA loans are 0% down. That's the first one they checked off on there, right? No required down payment. You can put a down payment down, because what does down payment do? It lowers your payment responsibility, your mortgage responsibility. Okay. There's no PMI on a VA loan at all. There's no PMI on a VA loan. Okay. Easier credit. There's no minimum credit score. The interest rates are lower. The debt to income ratios that we talked about earlier, they're higher for VA loans. No prepayment penalty. Like I said earlier, it is one of the best, if not the best, loan product there is out there available, right? Here's a con, though. It's only for your primary residence, with that caveat that I mentioned earlier too. Talk with your loan officer about that. There's a VA funding fee. It's a required upfront fee to fund the loan, okay? and they're slower to close. A lot of sellers will not accept an application, a offer if it has a VA loan buyer. Takes a little longer to close, an extra 2 to 5 days. It's not that much longer in that regard, but it takes a little longer to close. They're a little more strict on what their requirements are. It's a more complex transaction in those regards as well. And some sellers, again, they're disinterested because they don't want to go through some of those strict processes that they're required to go through before closing on that loan, because anything that needs to be done to that property, of course, you being the buyer but not having purchased yet, you can't do those things on the property, so they're required of the seller, right? And it's not for everybody, those in active duty or reservists, those who are in the reserve, or the veterans, okay? So that's what it's for. How many of y'all want to enroll right now? All right, we went through the FHA, we went through the mortgage steps. And again, I apologize that my slides had gotten out of order, okay? Back to the mortgage loan application process. For employment, the time and the salaries are the considerations that they're going to be looking for when you're applying for your application. So have these things prepared when you're actually going to apply for your loan, because they're going to ask you for it. And of course, when you are contacting them or you're stopping in, if you don't have it with you, well, then you'll just contact them back to get it to them. But why not go in already ready and prepared and potentially get your pre-approval that day or in the next 48 hours, okay, depending on the lender's turnaround time, okay? For your income, they're going to be looking for your alimony, proof of alimony, your 1099 if you're self-employed, or your W-2, your stubs, whatever have you. Any assets that you have, they're going to see accounts for those, for your real estate, investment properties, things like that. Okay. Any debts that you have, obviously they're going to want to see that. So you basically providing them your income statement, your balance sheet, right? Any mortgage payments that you have, any credit cards, debts that you have, any car notes, anything like that. And remember, this is a snapshot of what you have right now. This is a snapshot of what you have and your status right now. So don't go changing anything after you are providing this information. Some will give you a pre-approval once you call them on the phone or fill out their online application, and they'll send it right over to you based on everything that you told them that you earn, everything you told them that you owe. Then you have to follow that up with actually providing this documentation, which is why many realtors and many sellers won't accept a qualification letter, because that's all they did was just qualified you. They just qualified you based on what you said. And you'll notice if you read that pre-approval or that qualification closely, it says all of the information above is based on receiving or client providing supplemental documentation or proof, if you will, for these the things that they've just shared. So it's a pre-qualification. Basically, it's not even guaranteed that that's the amount that you're actually going to be pre-approved for. So most realtors might say, no, we need you to get a pre-approval, which a lot of lenders will do, called desktop underwriting, or DU, right, where they actually run your information through their system, and you've provided all of this paperwork. And so when they provide that approval, it's you've gone almost 3/4 of the way through the loan process once you actually fill out the loan application and find a property and go under contract, because they've done all of the wait period information. The only thing that's left to be done is the inspection, the appraisal, and then clear to close, right? So you want to get that pre-approval, and preferentially that desktop underwriting option from a lot of lenders, okay? Financial blemishes, they're going to want to know if you've got any bankruptcies, any foreclosures, collections, or judgments. Most bankruptcies need to be very seasoned, discharged, like 5 years, okay? So you need to make sure you know that, and don't withhold that because you think it's just sweet to, tell them what you tell them on the phone, but then provide them what you provide them later. Then you've gotten yourself, further into the process and put an offer on a property and sending it to the bank. Now they see that there's a bankruptcy on there that you didn't mention. Now this loan is not going to be taken care of. Now, true, you can go ahead and move around and get to another lender and have them take a look at it and see if, they allow bankruptcies in a, shorter period of time. But why do the rabbit chase? Why mess with a seller's property on the market that they actually could have got a bona fide buyer? Why waste your time when you can actually wait till you actually get bona fide yourself, right? So be diligent and responsible. And then, of course, we talked about the mortgage types and the VA certificate of eligibility or the CO, and then your loan estimates. They're going to basically tell you about your terms and your costs, and you definitely want to know those things because you're going to want to validate the fact that this is actually a good situation for you to get yourself into, right? That's what you want to do, okay? Loan processing time frames and what goes all into that vary lender to lender. They're going to order your credit report if they haven't already pulled it for your pre-approval. Order your credit report. They're going to start to verify that employment and your bank deposits and all that. So be ready to prepare that information, right? Don't be hesitant to provide it when your realtor is asking for it, because what your realtor is doing is verifying that they've actually qualified the client. When the sellers are looking for their offer from them, they're indicating, hey, I've already qualified this purchaser myself. I've gotten bank statements to actually show that they have blah, 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 blah. Even though the realtor is not the lender, it is still a part of a qualifying process, and you don't have to provide it to your realtor, but you certainly have to get it ready for your lender. What I do personally is I ask for it up front because I know it's going to be asked for from the lender. And what I do is I aid and assist in the process because I want to make sure that if you are ever at work or wherever and you can't get the information in, or you don't have the capabilities electronically, digitally to do so, you got me right here. Tag me. I'm it. I get it in for you, right? So I work like that as a tag team with my clients. They're going to order a property inspection if that's required, requested, okay? They're going to also order the property appraisal. No getting around that one, right? Because they want to make sure what? That property is actually going to be worth that value of the loan that they're actually going to be putting on that property for you. And last but not least, they're going to order a title search to make sure there are no what they call clouds on the title. Make sure that nobody else can come and claim this property, right? Make sure there are no liens on this property that are going to be required to be taken care of. And guess who's going to fall on if they don't do their diligence with that? You bet. That's going to be you. So all of these are diligences that go through the loan process time frame. All right, we got a little monopoly board here, which I love. The underwriting process I touched briefly on, right? The underwriting decision basically is going to be one or two things: approve your loan or reject your loan. And then, of course, you're going to get reasons that it was rejected as well, which then gives you an opportunity to work on those things. So that's why I also like that as well. Okay. You're going to get an interest rate. And here's some things that lenders may or may not just offer upfront. So please know this, write it down, put an asterisk, do whatever you do, screenshot this. Ask to have your interest rate locked. Ask to have your interest rate locked. Because if you don't find a property, or even if you don't close by the time your interest rate and interest rate go up and they're not locked, you're susceptible to paying that higher interest rate. So lock it. Okay. Ask about it if they offer loan interest rate locks. Some lenders may say they don't until they get an offer, right? Until they go into contract. I'm sorry. Some lenders will say that, and some will go ahead and lock it while they give you the pre-approval. It depends. Just ask. Okay. And for pre-closing, again, there are going to be title insurances and contingencies and things like that. And as you can see, you start over there in the top left, you go through the pre-qualifying process or the pre-approval, preferably. You go through pre-processing for the loan application. Then we start looking for you a home because we need to know what we're going to be searching for. What's the number? What's the magic number? What's the range? Even if they pre-approve you for an amount, you might not want to pay that amount, right? You might want to pay less than that because you know what you can afford. You know if you want to pay $1,200 or $1,300 or $1,500 or $2,000 or $3,000 a month. You know if you only want to pay $900. And yes, sometimes your mortgage note is less than a rental payment would be. Absolutely. And you're steady building equity into the property every time you pay your monthly note. That's some portion of that is going back into your property as equity. Okay. Once you find a home, you go under contract. You have your inspection done, unless it's an as-is property where inspection would just be for your informational purposes only. The inspection, I like to call it, is basically another round of negotiations, because if it's not as is, of course, and even if it's as is, sometimes you still can ask because the sellers are already in a under contract situation. They've taken the house off the market. Once it goes under contract, they have to do that. And you find that there's some things in the property that you're not really ready to live with. You don't want to live with. And you want to see if the sellers will take care of it, or if they'll provide you a credit so that you can take care of it, or meet you halfway in the middle and provide you a portion of the credit, right? All of those things are options when you get to the home inspection phase. And there's a time frame that you have to get that information into your realtor to indicate to the seller's realtor that you want to negotiate on these items. You then have an opportunity to say, hey, if they won't budge on this, then I want to cancel this contract without penalty and get your earnest money back. We didn't talk about earnest money because this is a qualifying factor. We'll get more into that with the purchase of a property in our next workshop. But just keep in mind, overall, this is basically talking about what the home inspection can mean as far as a second round or another round of negotiations. So December 12th will be the purchase. We'll get into earnest money and probably more in depth about this as well as far as the inspection, okay? After that, then it goes to underwriting, because now you've actually confirmed that you're willing to move forward with this deal, and you're sealing the deal halfway right now. And then it's going to get approved. And then the appraiser actually is going through the approval process. You're not getting approved just yet, but it's going through that approval process where it would be then called a conditional approval. So based on all of these factors, the bank will issue what's called a conditional approval, meaning once all of these things that we're calling conditions are met, then we will approve this loan and then get it clear to close. So you start making sure those things are met. And again, that's where I come in as a tag team. Some of those things may need to be sent in. They may ask for another month of check stubs or bank statements again, because the loan process is taking a little more than 30 days. Every time another cycle goes around for a bank statement or page stubs or things like that, they're going to want to ask for those documentations again because they need to be updated, because otherwise it's as if you submitted old documentation on a new loan, right? Then you're going to have your pre-closing information, which are your settlement costs on your, what's called your settlement statement, or your RESPA, Real Estate Settlement Protection Act. That's your RESPA that basically dictates that any and everything that happens transactional wise with this property monetarily needs to go on this RESPA or the HUD-1, okay? Then you have your closing disclosures, which I mentioned earlier. Your financial institution has to provide to you, disclose to you what your closing costs are going to be, right? What your estimated terms are going to be. They have to provide you that. And then a couple of days before you actually close, you're going to receive final numbers. And those two numbers need to be within a specific distance from one another in order for the bank themselves not to be penalized for underestimating, severely underestimating, causing you to enter into an agreement that you would have otherwise not agreed to had you known the terms that actually came to be final were the terms. So if their estimate misleads you in any way, they can be held liable for that, which is something new in the TRID laws that recently just occurred, okay? You do a final walkthrough of the property before you close. Even though you've seen it already, it's time to go check it out again just to make sure that that thing you wrote an offer on is still that thing you intend to buy. So we do a walkthrough. If there were some things that were supposed to be done through the inspection negotiation by seller, you would be going over there at that final walkthrough to check to make sure they were done. If that's not the case, you're just going to check just to make sure everything is there that you wrote an offer on to be included, or just to make sure that the roof is still there, the floor is still there, the doors are still there. Oh, I've seen some things. Make sure the fixtures are still there. If it said stainless steel refrigerator, you want to make sure before you close that those didn't get swapped out for old black refrigerators or white refrigerators, or 1930 fridges and stoves. You want to make sure that what you wrote an offer on and items that you said were to be included are in fact going to be included. And then the title company finalizes the title information, which is the instrument through the title company, and it's signed by all parties. And then boom, you sign and you're ready to close, okay? For closing, you get a 3-day review period on those numbers that I just told you about. That needs to be that estimate that the lender provides you, as well as your final numbers and what they are. You actually get 3 days to decide if you still want to close on this thing though, right? You get 3-day review period. If you decide you don't want to, without penalty, you get to just back out and say, I don't want to proceed with this. You get 3 days to do that, okay? How long will it be till I get my money, right? How much time will this take? Can I have the keys now? When is this going to be officially closed? There's a such thing called as a dry closing. You may get to the table and the lender hasn't sent funds over yet for a number of reasons. Could be the fact that a condition is still waiting to be fulfilled that the buyer may have needed to fulfill, and you may have just done it that day. Or somebody may have dropped the ball and just realized they didn't get one more thing that is required by their investors guidelines, and then they ask you for it at the 11th hour, and then you rush and you're trying to get it to them, or worse yet, you can't get it to them. So you're gonna close, but it's gonna dry close, which means the seller isn't going to get their money. The bank is not going to give them their money if the conditions have not been met yet, right? So we need to make sure that everything is met, which is why that preparation that I mentioned earlier is so important. It's so important. Okay. All right. Key closing documents. There's a closing disclosure I just mentioned, which is the HUD or the TIL, which is called the Truth in Lending Disclosures, or right now they actually call them just disclosures, which is a summary of your loan terms, your monthly payments, closing costs, all of those things. There's the promissory note, which is basically your mortgage note, right? How much you're how much you're owing, and that you basically promise to pay that amount, right? And then you also have verbiage in there that'll indicate if you don't pay, the bank has a right to foreclose, right? We are all very familiar with that term now, but there was a time where no one even knew what that was in their closing documents, right? There's also a deed of trust. It secures the note and it gives a lender a claim against the home if you fail to live up to the terms. And then, of course, a COO, or a certificate of occupancy, if it's newly constructed, is a legal document that you're going to need to move in, because no one ever occupied this property before. So it needs to be validated that it is, in fact, ready to close. It's got a calendar over here. This is pretty cool. The 23rd. How many of us want to close by the 23rd of next month? I got some lenders that can make that happen for you. Okay. And that brings us to the end of our workshop. We'll save the rest for question and answers. We've got about 15 minutes left. Actually, I'm sorry, we've got about 5 minutes left. Our upcoming workshops, November 14th, is going to be the search. We're going to actually talk about what that looks like. Hopefully by then, some of you will have then already gotten your pre-approval, right? The speaker is going to be Rob Rose. He is the executive director of the Cook County Land Bank. The Cook County Land Bank, if you didn't know, is where you can go to find a lot of the properties that are purchased by the Cook County Land Bank for taxes, defaulted taxes in Cook County, and then they remarket them and sell them in oftentimes areas that are in need of regentrification, right? They're very, very diverse, oftentimes non-diverse areas. There are sometimes, a lot of them are on the south side, some are in the suburban areas of Chicago. Some suburbs actually don't allow Cook County Land Bank. I think it's only about 3 or 4 of them that don't allow Cook County Land Bank to come in, because when they do come in and they purchase the properties, they're actually going to board the properties up if the properties aren't, if they're abandoned, they haven't been cared for. Although it's a good move and it's a good thing that they're coming in and they're actually buying these properties and making them affordable and resale for people to purchase, even investors. Oftentimes people just don't want to see the board ups in their communities. But what is your other option unless you're buying it yourself, as a suburb or as a village, right? December 12th then is the actual purchase. So we're talking about the search and one resource to go and search on the Cook County Land Bank. Then we're going to talk about the purchase, what that looks like outside of what we just discussed, right? A lot of it we just touched on, but as far as the purchase in and of itself, we're going to go through what that looks like when you actually get set up on a search service to pull up your properties, and then you're actually going out to purchase those properties, one or whatever you're doing, purchasing bulk properties, whether it's an asset for a primary residence investment or it's a commercial property. January 9th is going to be renovation. We're going to have our speaker, New Vision Construction, general contractor Ernie Pinkston. February 13th, we're going to be talking about the sale or the hold, right? We're talking about the sale or the hold. If you're selling, purchasing your property to renovate it and then sell, or purchasing it, renovate it, and then hold on to it. We're going to talk about what that looks like. And then March 13th is going to be the management of those properties. Should you consider to purchase the property and hold it, you're going to need to manage those properties either yourself or hire a management company. Or if you want to sell that property, you're going to need to have a management system in place going throughout that sale process, making sure that your after rehab value is there, making sure your comparables that you're using to determine that value, they're still valid, because they're only good for 6 months, okay? To register for any of those additional workshops, go to register on the Facebook page at SeanRPinkstonRealestate.com. We thank you so much for joining us for the Millennials Investing in Real Estate virtual edition of the workshops that were brought to you again at the beginning of the year into the pandemic. So we added the 2 on that we were not able to do in person. Now we have 6 modules, and we're hoping you guys got some fantastic information today that can help you get started on your financing. Now you understand why you need to get pre-approved, how important that is for you and your professional to start searching for properties that make sense for you. And until We meet again next time. Take care of yourself and take care of those around you. And as always, vote. Get out and vote. Make sure you're voting, because if you don't vote, your voice doesn't count. And I said it. If you don't vote, your voice doesn't count. We want to make sure that we are doing our diligent responsibility and getting out there and voting to make a difference in this country. Okay? Take care.